Next thing what we are going to study about in this video is about budget expenditure and measures of government deficit. These are the two important things from the particular chapter. So first of all, let us talk about budget expenditure. Now when we talk about budget expenditure, they are of two types: revenue expenditure and capital expenditure. Okay, so if you remember, we have studied about budget receipt. Under budget receipt, we had studied capital receipt and revenue receipt. Same way, under budget expenditure, we are going to study about revenue expenditure and capital expenditure. Okay, so let us start looking at it. First is revenue expenditure. What do we mean by revenue expenditure? So it refers to the expenditure which neither creates any asset nor causes a reduction in any liability of the government. So, revenue expenditure are basically those expenditures which will not create any asset for the government, neither it will reduce any liability of the government. Such kind of receipts are called as revenue expenditure. Such kind of expenses are called as revenue expenditure. These are recurring in nature. That means these are the type of expenses which are very frequent in nature. Very quickly and very frequently government undertakes this kind of expenses. So it is incurred on normal functioning of the government and the provisions for various services. So these kind of expenses are usually incurred for all the day-to-day normal functioning of the government as well as the various provisions which the government provides. Example of revenue expenditures are payment of salaries, pensions, interest, expenditure on administrative services, defense services, health services, grants to state, etc. So these are the few major examples of your expenditures, revenue expenditures. So once again, revenue expenditures are those expenses which will neither create any liability nor it will reduce any asset of the government. So such kind of expenses are called as revenue expenditure. Now, an expenditure to be called as a revenue expenditure, again we have two essential conditions. On the basis of this, you can identify that whether the expense is a revenue expense or not. First is the expenditure must not create an asset for the government. Any expense which will create asset for the government will not be called as a revenue expenditure. Any expense which needs to be called as a revenue expenditure should not create any asset for the government. So example, payment of salaries or pension is a revenue expenditure as it does not create any asset. When government pays salaries to its government employees or pensions to the people, it is not going to be called as a revenue expenditure since it does not create any asset. Government is basically doing the payment. So this is not creating any asset for the government. The amount on construction of metro is not a revenue expenditure as it leads to creation of an asset. So again, if there is some investment which is done by the government on constructing a metro, constructing a bridge, constructing a road, highways or anything like that will again not be considered as a revenue expenditure as it is going to create an asset for the government. So next is expenditure must not cause decrease in any liability. So first, it should not create any asset for the government. Second is, it should not decrease any liability of the government. Any expenses which decreases the liability of the government will not be called as a revenue expenditure. So for example, repayment of borrowing is not a revenue expenditure as it leads to reduction in liability of the government. When government repays its borrowing to any financial institution, union territories or any foreign country, repayment of these borrowings will again not be termed as revenue expenditure since it is reducing the liability of the government. And we have already said that revenue expenditure should not reduce the liability of the government. But when government does repayment of its borrowings or repayment of its loan, it is going to reduce the liability of the government. Next is capital expenditure. The expenditure refers to expenditure which create asset or causes reduction in liabilities of the government. So the expenditure will be called as a capital expenditure if it creates asset for the government or it reduces the liability of the government. Just opposite of revenue expenditure is going to be the capital expenditure. These expenses are non-recurring in nature. That means these expenses are not going to be done very frequently or very regularly. It is going to add capital stock of the economy, increase its productivity through the expenditure on long period development programs like metro, flyover, bridges, dams, etc. So basically, this is going to add on to the capital stock of the country, since if the government spends or invests money on constructing a bridge, dam or metro or anything, it is going to add on to the capital stock. We are going to get more of bridges, more of metro stations. So again, here what is happening? There is a creation of an asset. Example, loan to states and union territories, expenditure on building roads, flyovers, factories, purchase of machinery, repayment of borrowing, etc. are going to be the very good examples for capital expenditure. Now again, to call an expense as a capital expenditure, we have to satisfy two basic conditions. First condition, the expenditure must create an asset for the government. Whatever expense the government is going to do should create an asset for the government. Such kind of expense will be called as a capital expenditure. Example, construction on metro is a capital expenditure, as it will lead to the creation of an asset. Constructing of metro, constructing of buildings, constructing of bridges, constructing of dams, all of these will be called as in capital expenditure, because these are the expenses which is going to add on to the stocks of the economy, right? Add on to the capital stock of the economy. It is going to create asset for the government. Second condition is the expenditure must cause a decrease in the liability. Any expense to be called as a capital expenditure should decrease the liability of the government. Example, repayment of borrowing is a capital expenditure as it leads to a reduction in the liability of the government. If government is doing repayment of its borrowings or repayment of its loan, it will reduce the liability of the government. And since it is reducing the liability of the government, it will be called as a capital expenditure. Payment of salary, interest or pension is not a capital expenditure, as it neither creates an asset nor reduces the liability. So if we talk about payment of salary, interest, pension or anything such like that, these will not be the capital expenditure, since it is not creating any asset for the government nor it is reducing any liability of the government. Now, how are you going to classify the difference between the revenue expenditure and the capital expenditure? On the basis of what things you can understand that which expense is a revenue expenditure and which expense is a capital expenditure. So, an expenditure is a capital expenditure if it creates an asset or reduces a liability. An expense will be called as a capital expenditure if it is creating any asset or if it is reducing the liability of the government. Whereas an expenditure will be called as a revenue expenditure if it neither creates any asset nor reduces any liability. So expenditure will be called as a revenue expenditure if it neither creates any asset nor it reduces any liability. So if you understand the basic meaning of revenue expenditure and capital expenditure, you can very easily classify the different examples or the categories. First, let us classify what is subsidies. Now, when government gives subsidies to the people, what kind of expense is this? Is it a capital expenditure or is it a revenue expenditure? So, but obvious, it is a revenue expenditure. What are subsidies? Subsidies are basically, in a very simple language, is nothing but the discounts which government gives to the poor people. So, it is a revenue expenditure as it neither creates any asset nor reduces any liability of the government. So, when we talk about subsidies, subsidies are going to be the revenue expenditure as it will not create any asset for the government, neither it is going to reduce any liability of the government. Defense capital requirements purchased from Germany. Now, we need some capitals, guns, bombs or anything like that, which India is purchasing from Germany. Now, which kind of expense is this? So, it is going to be a capital expenditure as it is increasing the asset of the government. For example, we are purchasing guns. Guns are the asset. So, it is going to increase the asset of our country. So, when there is an asset creation, those kind of expenses are called as capital expenditure. Third is grants given to the state government. Grants are nothing but in the form of gifts, One of the very simple way to understand the meaning of grant is nothing but gifts. If government is giving grants to some other foreign countries, then it's a revenue expenditure because it will not create any asset nor it is reducing the liability. Gift is something which is unilateral, which is one-sided transaction. So if India is giving gift or if India is giving grants to Germany or to USA, these kind of expenses will be called as a revenue expenditure because these expenses are not going to create any asset, neither they are reducing the liability of the government. Next, let us understand about the government deficit. First of all, let us see what do we mean by government deficit, and then we will be seeing the measures or the steps which we can take to control the government deficit situation. What is government deficit situation basically? So we know that there are few receipts for the government, there are few expenses of the government. When the expenses are more than the receipts, this situation will basically lead the government into a deficit situation, wherein the government does not have enough amount of money to invest or to do the expenses. So say suppose the receipt of the government is 100 rupees but the expense of the government is 200. This situation will be called as a deficit situation. So let us move ahead. Budgetary deficit is defined as the excess total estimated expenditure over total estimated revenue. So basically budgetary deficit or budget deficit means more of expenses and less of revenue. When government spends more than it collects, then it occurs or it incurs a budgetary deficit. So when the expenses of government are more as compared to the income of the government, this will lead to the situation of budgetary deficit. With reference to a budget of Indian government, budgetary deficit can be of three different types. Now there are three different types of deficit situation. First is revenue deficit, fiscal deficit and primary deficit. One by one, we are going to see all the three kinds of deficits. First, as I said, revenue deficit. Second, fiscal deficit. And third is primary deficit. So let us begin with the first one, that is revenue deficit. Revenue deficit is concerned with the revenue expenditure and revenue receipts of the government. Whenever we talk about the deficit situation, I said there are three types of deficit situation. The first situation is revenue deficit. When we talk about revenue deficit deals with two things, revenue expenditure and revenue receipts. So basically the deficit will talk about two things, revenue expenditure and revenue receipts. This will basically refer to excess of revenue expenditure over revenue receipts during the given fiscal year. Fiscal year is nothing but one financial year or accounting year, which is from 1st April to 31st March. Revenue expenditure, when revenue expenditure is more than the revenue receipt, this kind of deficit situation of the government will be called as a revenue deficit. So a very simple formula to find out revenue deficit is revenue expenditure minus revenue receipt. Say suppose for one financial year or for one fiscal year from 1st April, say suppose 2021 to 31st March 2022. This is your one fiscal year. In this fiscal year, the revenue expenditure was for 500 rupees and the revenue receipt was, say suppose, 200 rupees. That means your revenue deficit is minus 300. That means your revenue deficit is 300. Revenue deficit signifies government's own revenue is insufficient to meet the expenditures on normal functioning of the government departments and the provision for various services. So whenever we talk about revenue deficit, we see that this is the situation wherein the government is unable to meet its expenses with a given amount of income. That means the expenses of the government is more as compared to its income. What are the implications of revenue deficit now? So there are different implications. First, it indicates the inability of the government to meet its regular and recurring expenditure in the proposed budget. So first and the foremost inability of the government is to meet its regular and recurring expenditure in the proposed budget. That means government is unable to meet its expenses with a given amount of income. That is the first implication. Second, it also implies that government is dissaving. So that means government is not making any kind of savings. There is dissaving happening. That is, government is using up savings of the other sectors of the economy to finance its consumption expenditure. That means basically government is utilizing all of its finances for different kind of expenses. For all of its savings are getting utilized for the different kind of expenses, different kind of consumption expenditure. So the savings are also now gone. There is no savings basically left with the government. And this situation will basically lead to the problem of dissaving of the government. Next, then we say that it also implies that government has to make up this deficit from capital receipt through borrowings or disinvestment. Now, to make up this situation, the third thing what the government will have to do is disinvestments. That means we already studied the meaning of disinvestment. Disinvestment means selling off its all the public enterprises to the private, or selling off these shares, or doing borrowings from other union territories, foreign countries, or from other basically financial institutions. This will solve the problem of revenue deficit. But again, it is creating some kind of problem. Since we are going to borrow money from other financial institution, it will create a liability for the government. Then revenue deficit either leads to increase in liability, as I already said, in the form of borrowings, or it will reduce the asset through disinvestment. If government does borrowings, it will create liability on the government. If government is doing disinvestment, it will reduce the asset of the government. In both the things, there will be some or the other problem taking place. Now, use of capital receipt for meeting the extra consumption expenditure leads to an inflationary situation in the economy. What will happen suddenly now? Suddenly, the prices of goods and services will increase. And this is a situation of inflation. So, whenever capital receipt situation arises, it will create the problem of inflation in the economy. So, higher borrowings will increase the future burden in terms of loan amount and interest payments. So, higher borrowings, more the borrowings, more will be the burden on the country, more the burden will be on the government to repayment those loans, and it will increase the interest as well. High revenue deficit gives a warning signal to the government either to curtail its expenditure or to increase its revenue. So, whenever the government comes at this point of time, it will give a warning signal to the government that you have two options to solve this problem. First, you should reduce your expenses. Or second, you should increase your revenues. These are the two options available with the government. Now, according to the far-sighted approach, revenue receipts should always be more than revenue expenditure so that surplus can be used for development projects. So, of course, it is well said that it is always good to have surplus amount of money. That means the expenses should be less and the revenue should be more, so that the extra money or the surplus money can be utilized for developing some other projects as well. So, Indian budget is facing revenue deficit for past several years. So, if we talk about the Indian budget, it is facing the problem of revenue deficit from last few years. Now, what are the measures or what are the steps to reduce the revenue deficit problem? What we can do to reduce or solve the problem of revenue deficit? First is reduce the expenditure. So, first solution to solve the problem of revenue deficit is to reduce the expenditure. It is asked from the government that kindly reduce your expenses so that we can solve the problem of revenue deficit, right? So, government should take serious steps to reduce its expenses and avoid unproductive or unnecessary expenses. So, reduce your expenditure. Don't do any expenses or any unproductive activities or unnecessary activities. Second solution to it is increase your revenue. Increase your revenue, then you can pay off all your debts, pay off all the expenses, and you can go through all the consumption expenditure. So, government should increase its receipts from various sources of tax and non-tax revenue. So, this is the other solution to it. The next type of deficit about which we are going to talk is fiscal deficit. What is fiscal deficit now? So fiscal deficit is present or is more comprehensive when we talk about budgetary imbalances. We know already budget is imbalanced when the expenditure is more than the receipts or the income of the government. So it is a widely used budgetary tool for explaining and understanding the budgetary development in India. When we talk about fiscal deficit, it is one of the most popular budgetary tool you can say, which is used for measuring the budget imbalance in the country India. Fiscal deficit, very important now. Fiscal deficit refers to the excess of total expenditure over total receipts, wherein we are going to exclude the borrowings during the given fiscal year. Fiscal year is again nothing but your accounting year or financial year, that is from 1st April to 31st March. Basically, what is fiscal deficit? So fiscal deficit is nothing but the excess of total expenditure over total receipts. Now do not get confused between revenue deficit and fiscal deficit. Revenue deficit was the difference between revenue expenditure and revenue receipts, whereas fiscal deficit is the difference between total expenditure and total receipts, wherein we are going to exclude the borrowings. Whatever borrowings or whatever loan we have taken, that means the Indian government has taken, should be excluded while calculating fiscal deficit of the country. Now, there is a very good formula given over here which is very important. Fiscal deficit is equals to total expenditure minus total receipts excluding borrowings or loan taken. So fiscal deficit has one very simple formula, that is total expenditure minus total receipts, wherein we are going to exclude the borrowings or the loan taken from abroad or any financial institution. The extent of fiscal deficit is an indication of how far the government is spending beyond its mean. So whenever there is a situation of fiscal deficit in the country, it will depict or it will show that how far or how much more the government is spending and the income is less or the receipts are less. So the total receipts exclude borrowing will include what all things? So it will include revenue receipts and it will also include the capital receipts excluding the borrowings or non-debt creating capital receipts. Any receipt should not create a debt, should not create a liability. We will be excluding that while calculating capital receipts. So total revenue includes two things, revenue receipts and capital receipts. Capital receipts will be excluding from the borrowings. No liabilities, no loans, no borrowings should be included while computing total receipts. Non-debt creating capital receipt, what does it include? So it includes all the capital receipts except the borrowing. So non-debt creating capital receipt is going to include all the capital receipts leaving behind the borrowings. We will be not including borrowings as I already said. Now such receipts do not give rise to debt. So these kind of receipts should not give rise to any kind of debt. Debt is nothing but liability on the government. Example, recovery of loans or proceeds from disinvestment. These things will not be included. Now, what are the implications of fiscal deficit? What happens when there is the situation of fiscal deficit? First thing what can happen is a debt trap. Very important concept. What is debt trap? So fiscal deficit indicates the total borrowing requirement of the government. We will be talking about the total borrowings which are done by the government. That is nothing but fiscal deficit. Borrowings not only involve repayment of principal amount, but it will also increase the payment of interest. Yes, definitely. When any country borrows money, it has to repay the principal amount as well as the interest. So borrowing will involve or will include the principal amount as well as the interest charged on that amount. So interest payment increases the revenue expenditure, which leads to revenue deficit. So interest payment will basically increase the revenue expenditure of the government. When the revenue expenditure increases, ultimately it will give rise to revenue deficit. It will create a vicious circle for fiscal deficit and revenue deficit, wherein government take more loans to repay the earlier loans. And as a result, ultimately the government will be caught into a debt trap. Of course, say suppose government has taken loan from A. Now to repay the loan to A, government will be taking loan from B. To repay the loan to B, government will again take loan from C. Then D, E, F. Likewise, this will be a very bad and dangerous, which is called as vicious debt trap for the government. This is how government will fall more into taking borrowings or loans. Next thing is inflation. We know what is inflation. Inflation is nothing but increase in general price level of all the goods and services. Whenever this thing happens, the country or the economy goes into the situation of inflation, right? So government mainly borrows from RBI to meet its fiscal deficit. Whenever government is into a fiscal deficit, in the problem of fiscal deficit, government will go and take or ask for help from RBI. That is from Reserve Bank of India, and we all know this is our central bank of the country. So government will go to RBI for the help whenever it is in the situation of fiscal deficit. Now RBI, what will RBI do? RBI will print new currency to meet the deficit requirements. To solve this problem of government, RBI is now going to print new currencies so that we or our country can overcome with the deficit requirements. We can come up with the solution. So it increases the money supply in the economy and creates inflationary pressure. Now what will happen? Now since RBI is printing more and more new currency, we will be trying to cover up our deficit requirements. This will increase money supply in the economy and ultimately it will create an inflationary pressure on the government or on the economy. Next is foreign dependency. So during the time or during the situation of fiscal deficit, the next thing what Indian government can do is borrow money from foreign countries. So government will also borrow from rest of the world, which raises its dependence on other countries. Of course, now what is happening? Indian government is depending upon some foreign countries for borrowing money. So we might be borrowing money from USA, we might be borrowing it from Russia, we might be borrowing it from Japan, China, or whatever the country is. So basically, Indian government is now going to be dependent on other foreign countries. So foreign dependency also increases during the time of fiscal deficit. So debt trap, inflation, and foreign dependency. Fourth is it will hamper the future growth of the country. But obvious, if our country or if our economy is in the situation of fiscal deficit, it will hamper the future growth of the country, future growth of the economy. Borrowing will increase the financial burden for future generation. It will adversely affect the future growth and development prospects of the country. Now, since we are in the situation of fiscal deficit, government will try to borrow more and more money from foreign countries. When government increases its borrowings, of course, the liability of the government increases. Liability or the debt of the government increases. When this increases, the pressure, the financial burden or the financial pressure on Indian government will also increase, and hence that thing will be also impacting our future generation. So of course, it will be hampering the future growth. Next is sources of financing fiscal deficit. Now there are different sources or there are different options through which we can finance or solve the problem of fiscal deficit. So basically, very important implications of fiscal deficit. If there is a problem of fiscal deficit in the economy, it can lead to the problem of debt trap. It can lead to the problem of inflation. It can hamper the future growth. It will increase the dependency of Indian government on other foreign countries. Now they have also given you different sources through which you can finance the fiscal deficit, or you can basically, what are the different options through which you can overcome the problem of fiscal deficit. So now let us talk about the different sources to finance the fiscal deficit. The two major sources is one is borrowings. First thing what Indian government can do during the time of fiscal deficit is borrowings. Borrowing is nothing but taking loan, kind of a loan, borrowing money from some other financial sources. So fiscal deficit can be met or can be solved by borrowings from the internal sources like public, commercial bank, etc., or else external sources like foreign governments, international organizations, etc. So for borrowings also you have two options. Okay, you can borrow money from any internal source as well as from the external source. Internal source can be public, it can be a commercial bank, whereas external sources are foreign governments or international organizations. So first thing through which the problem of deficit can be solved is through borrowings. Next is deficit financing. Simple meaning of deficit financing is printing of new currency. So whenever you hear the term deficit financing, you should know deficit financing means nothing but printing of new currency. So government may borrow from RBI against its securities to meet fiscal deficit. RBI issues new currency for this purpose, and this purpose is basically known as nothing but deficit financing. So government might have to borrow from RBI. It is possible that government can borrow from RBI, that is the central bank of the country. Now to provide the loan, provide money to the government, RBI will have to issue new currencies, and the process of issuing this new currency is called as deficit financing. Borrowings are considered a better source as they do not increase the money supply, which is regarded as the main cause of inflation. Now, borrowing from RBI is considered to be one of the best source since it will not increase the money supply and it will not cause the problem of inflation. So, deficit financing may lead to inflationary trends in the economy due to more money supply. So, if there is a possibility that if there is a more money supply in the economy, then due to the more money supply in the economy, there might be the problem of inflationary pressure. Third type of deficit is primary deficit. So, we saw what is revenue deficit, we saw the formula of it, then we saw what is fiscal deficit, formula of fiscal deficit, and the third one is primary deficit. So, primary deficit is the difference between fiscal deficit of the current year and interest payment on the previous borrowings. So, primary deficit is nothing but the difference between fiscal deficit of the current year, that is the present year, and the interest payment which the country is doing for the previous year borrowing. For example, say suppose the current year is 2022. It is just an example. The current year is 2022 and government has done some borrowings in the year 2021. On this borrowing, government is doing interest payment. So basically, primary deficit is going to be the fiscal deficit of the current year, that is 2022, and the interest payment which Indian government is doing on the previous year's borrowing, that means the borrowing which might be done in the 2021. Formula of primary deficit is fiscal deficit minus interest payment. Again, fiscal deficit of current year and interest payment on borrowings from previous year. You have to remember this very properly. Fiscal deficit of current year minus interest payment of previous year. So, say suppose the fiscal deficit of 2022 is 1000 rupees and the interest payment which the Indian government is paying on the previous year's borrowing is, say suppose 500 rupees. So, in this case, primary deficit would be 500 rupees. Okay, this was just a random example to understand the meaning of it easy. The total borrowing requirement of government includes interest commitments on accumulated debts. So, when we talk about total borrowings, it will be including the government's interest commitments which they are paying on all the accumulated debts. Primary debt or primary deficit reflects the extent to which such interest commitments have compelled the government to borrow in the current period. What are the reasons? What are the interest commitments which the government has done in the current year? Now, what are the implications of primary deficit? What happens if our Indian economy or Indian government is in the situation of primary deficit? So, it will indicate how much of the government borrowings are going to meet the expenses other than the interest payment. So, primary deficit will basically show that how much of your borrowing, how much of the government's borrowing will be used to pay the expenses apart from interest payment. Say suppose the borrowing is 1000 rupees and in this interest payment is done for 500, remaining in the hands of government is 500 rupees. So this extra 500 rupees will be utilized for the other expenses, and this 500 is nothing but the interest payment and this 1000 is nothing but the borrowings of the government. So basically primary deficit shows you that how much of the government borrowings will be going for interest payment and how much will be left out for other expenses. So the difference between fiscal deficit and primary deficit shows the amount of interest payment on borrowing made in past. Very simple, fiscal deficit and primary deficit. A low or zero primary deficit indicates that interest commitments on earlier loans have forced to government to borrow. Now, if at all your primary deficit is zero or is very less, two situation, your primary deficit can either be zero, it can be less. Whenever your PD is zero or less, it will tell you or it will show that there are some circumstances because of which government has done the more borrowings. That means a government has still not paid the previous loan or they have not still repaid the previous borrowings. That is why they are forced to do more borrowings. Now primary deficit is the root cause of fiscal deficit. Very important. We say that primary deficit is going to be the root cause for fiscal deficit. Fiscal deficit takes place due to the primary deficit. In India, interest payment have considerably increased in the recent years. High interest payment on past borrowings have greatly increased the fiscal deficit. So nowadays, India has done a lot of borrowings. Since there are lots of borrowings, the interest payment of our country has also increased. And that is why there is the situation of fiscal deficit. To reduce fiscal deficit, interest payment should be reduced through repayment of loans as early as possible. Then they say that if you want to reduce the problem of fiscal deficit, it would be better that you reduce the interest payment or you reduce the repayment of loan as soon as possible. So these were the basically three types of government deficit situation: revenue deficit, fiscal deficit and primary deficit. Okay, all the three are very important. You should know what is the meaning of revenue, fiscal and primary. High chances numerical questions are also expected from this particular part.
Thank you for watching our video. For more updates, reach us on www.tgcampus.com or 1800-267-2677 or connect@tgcampus.com. Like and subscribe to our YouTube channel TG Campus In. Follow us on Instagram, Facebook and WhatsApp. Join our official Telegram channel TG Campus In. Chat with us on 8655682401.